92% of Americans self-report and say that they feel like they are not saving enough for retirement. In this video, I want to walk you through how to catch up for retirement and how to fill the savings gap that most people are facing, excuse me. The reason, in my opinion, that a lot of people are facing the savings gap, this retirement gap, which we know is a thing because EY published a study and found that there is, I think, 140 trillion or 260 trillion retirement savings gap. I can't remember the exact number. Regardless, people are not saving enough money for retirement, and that's what I want to show you in this video is how to catch up. I believe it is really two issues. The first is going to be taxes. If you think about how often they tax us when we make money, they tax us when we spend money, they tax us when we buy property, they tax us when we put gas in our car. They're constantly taxing us. And whatever those taxes don't cover when the government actually gets that revenue in and spends it, they just quite literally print money by putting in numbers on a screen. That's how the Federal Reserve works. And if you didn't see my other video explaining that, you can go watch that now. When they print money, they inflate the currency, which erodes the purchasing power of our dollar. In turn, it increases the cost of living, which is why the price of eggs. Someone actually joked to me the other day, they're like, why do you talk about eggs so much? And I was like, because I eat like 4 to 8 eggs a day. I love eggs. But the cost of eggs is through the roof. I used to be able to go to Costco and get 60 eggs for like $5.99, and now it's like $15.99. The price is absolutely ridiculous, and it's only going to get worse over time. This is just a reality that we live in. The cost of everything is going to go through the roof over the next 30, 40 years because of how much debt we have, because of how many unfunded obligations, unfunded liabilities we have. All of these things are going to fall on us. And then outside of Social Security, most people have no source of stable income. People do not have pensions anymore. People rely on 401ks that are tied up in mutual funds and target date funds, and most of them are getting anywhere between 6 to 8% on average, which is not a video hating on 401k. I do not hate the 401k. However, it is a very risky vehicle, and that's why so many people are at risk of sequence of returns going into retirement, which if you don't know what sequence of returns is quite literally the sequence of the returns. And so in the market, the stock market, so if we have a year where we lose 20%, the next year we lose 5%, we're down 25%. Say you had $1 million in your portfolio, that $1 million is now 750,000. And then let's say you're pulling 5% out a year. Well, now you're going to run out of money a lot faster than if you retired into an up market. Not going to explain sequence of returns in depth. I just go watch my other video. I'll link it below if you haven't seen that to understand what that is. The point of this video is to show you, okay, what are your options here? So the solution is something called mortgage-free life. This allows you to do really 3 things. Number 1, it's going to allow you to pay your mortgage off in the next 5 to 10 years. Number 2, it's going to save you a ton of money in interest, which can be redirected into an asset that generates income. And number 3, it uses what's called an index universal life policy to create stable, long-term tax-free income. This is going to protect you against market volatility with stable, predictable growth, and it's going to reduce retirement income taxes by shifting to tax-free income streams. It is no secret that I like life insurance. I use life insurance. I teach people how to use life insurance. And the reason is mainly because of the tax benefits, but also the way that it generates income, specifically with mortgage-free life. This isn't going to be a video that I teach you how life insurance works. I have other videos that explain that, which I will link below. So let's say that you are 47, 48, 49, somewhere in that range, and you have a $300,000 mortgage. And the reason I'm using that number is because I see so many people that come to me in this exact situation, late 40s, early 50s, maybe have 150, 200 grand saved up for retirement. They have a lifestyle that costs a lot more than 100, 200, even $300,000 saved up. And they're like, what do I do here? I want to get out from underneath this mortgage, and I need to figure out something to create more tax-free income, just more income in general for retirement. So $300,000 mortgage, 4.5% interest rate, 27 years left, $2,000 a month on the mortgage payment, $10,000 a month of net income, that is take home after tax, $7,000 a month of expenses, and then $15,000 in savings. There, you can see that there. We are looking at a 9% line of credit. What that's going to do is that's going to allow them to pay off in 8.25 years, save $146,000 in interest, and make about $90,000 a year tax-free every single year for the rest of their life using an index universal life policy. If we look at the two different scenarios, one scenario, which is what they're in with their mortgage, it's going to cost them $218,000 over the next 27 years, which is 72%. So that's like the actual interest rate is 72%. And if you think about it, that's another reason why people are so behind on retirement savings, is because so much interest is getting siphoned out to the bank via their mortgage, and then taxes and inflation on top of that. It's like, how do I even save for retirement? Versus mortgage-free life, this is going to cost $72,000 in interest, which is 13%, which is the actual interest rate. 99 months, 8.25 years. So that is the results of mortgage-free life. Now, I want you to look at something that's very interesting, which is an amortization schedule. And if you have a mortgage, you can just go to your last mortgage statement, and you'll see how much you paid in interest and how much you paid towards principal. So we're 3 years in here, and as you can see, $1,100, $1,100, $1,100, $1,100. The interest payments are just ridiculous. This is why I say mortgage interest is front loaded. They're putting all of that interest in the beginning of the loan because they know, on average, people are going to refinance every 7 years, and then you're going to restart the cycle. So they just collect a tremendous amount of interest from us, the American people. But it doesn't have to be that way. You could just plug your numbers into this system. You could use this system, and we can instantly see if it's a fit. Now, let's say in this scenario, you're like, hey, I'm gonna get a raise, and I'm gonna make an extra $1,000. I'm gonna make an extra $1,000 a quarter, and that's gonna happen in 12 months from now. Let's see how much that actually adds to our pay down. So we went from 8.25 years to 7.5 years. So as you can see with the different inputs inside here, we can add things like, let's call it let's call this a pool. Okay, so let's say you want to put a pool in for $50,000. You're going to do that once. You're going to do that in 45 months when the kids are in high school. Well, as you can see with this system, pay off in 8.75 years, $137,000 in interest, and you're still going to make that $90,000 a year. This is not guaranteed, by the way. This is a projection, but it's based off conservative estimates. So even with those things added in, we're still going to pay off much ahead of schedule. So this is why I call it the retirement rescue plan, is because we're not changing how much you make or how much you spend. We're just using your money more efficiently. It's going to be working harder for you versus working harder for, the bank or someone else like that. So if you want information on this, you can find it in the link below. Understand that if you're in a situation where you feel like you're behind on retirement or saving for retirement and you need a way to catch up, mortgage-free life is one of the best ways that you could possibly catch up and fill that retirement gap. Even if you already have good savings, if you don't have good savings, doesn't matter where you're at financially, this is a great program. And I think this program really is the best fit for anyone that has a house less than $500,000 with a $300,000 or less mortgage, making under $200,000 a year. I think you'd be much better off just paying off your mortgage, using mortgage-free life, than really anything else. I think it's the best plan for those type of people. After that, I think there's an argument to be made, but really my job is not to persuade you whether or not to pay off your mortgage. If you already want to pay off your mortgage, this is the system for you. If you do not want to pay off your mortgage, it's not my job to persuade you to pay off your mortgage. Anyway, find some stuff in the link below. There's information down there. Hope you have a great day. Take care. Bye.